Let us begin by understanding the foundation of Cameron's model and why it is considered such a powerful framework in liquidity-based trading. At first glance, the model appears remarkably simple. However, behind its simplicity lies a complete framework built around liquidity, market timing, multi-time frame analysis, and precision execution. Rather than relying on prediction, Cameron's model focuses on understanding where the market is likely to seek liquidity, when that liquidity is likely to be taken, and how to position yourself once that process unfolds. At its core, the model follows a clear three-step process. First, identify where liquidity is resting. Second, wait for that liquidity to be taken. And third, execute with precision using a structured entry model. This framework helps traders focus on market behavior rather than market prediction. So, in the first step of Cameron's model, you want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. However, identifying the liquidity target is only part of the process. We also want to understand whether multiple timeframes support the same trading idea. The next step is to identify a stop rate in the opposite direction of the draw on liquidity using the 5-minute chart for execution precision. So now, let us shift to a lower time frame. Keep in mind that in this example, the liquidity zone is positioned above current price. At this stage, we're looking for a swing low to be taken out, which is defined as a stop rate, meaning liquidity is being cleared before the anticipated move. Once that liquidity is removed, the final step is to look for fair value gap formations in order to set a buy limit with structure behind it. If you cannot find any fair value gaps on the 5-minute chart, you can zoom further into the 1-minute or even the 30-second chart to gain more precision and refine your entry. In a bearish scenario, the logic remains consistent and simply flips direction. First, identify a key liquidity zone that price is moving toward. Then switch to the 5-minute chart and wait patiently for a stop rate above a recent swing high. After that, locate a fair value gap and place a sell limit at the beginning of the FVG, positioning your stop loss just above it for protection. Always give price enough room to move naturally within structure, and avoid placing your stop loss too tight, as that can result in premature stop-outs and unnecessary losses. In summary, Cameron's model is powerful because it forces you to trade with structure, patience, and logic. Instead of guessing direction, you align with liquidity, wait for stops to be taken, and execute with confirmation. When applied consistently, this 3-step framework transforms trading from emotional decision-making into a disciplined and repeatable process. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.